Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with the one and only Anna Kelly. How you doing, Anna?
I am doing great, Michael. How about you?
I'm doing well. We live in interesting times, certainly interesting economic times. As both end of it, we've studied the economy, finance for 60 years together. When you combine our ages, ooh, that's a long time.
We're
Uh,
old.
yeah, we are old. Yeah, at least, yeah. Anyways, I'm old. You're young. But where I'm going with this is we have a Fed rate decision today. I think most people agree that it's going to be 75 basis point raise again. It's going to get us up from 0 to 2.25 in about 4 months or 5 months. But I believe the Fed is painted into a corner and they only have two bad outcomes. And what, just so we're clear, the outcome is a recession, probably a nasty one, or inflation. I don't think they can fight both with the tools that they have today. And the reason I bring this up with you is the market, Wall Street, and the bond market, they seem to be guessing one way. And you know, in my little world, I don't see it. I think a lot of smart money is going, the Fed's going to fold and they're going to go fight a recession. And I don't think they appreciate that that was probably right for 40 years, but we're in the 80s now. And the boogeyman of inflation is not easy to beat. They can't show weakness. So what do you think? The Fed fights a recession or fights inflation?
Yeah, I'll say this, and you and I read a lot, right? And there's economists all over the place, there's
Yeah.
investors all over the place. And historically, to the credit of the people that think that the Fed's going to fight recession, right?
Mm-hmm.
Historically, once you've really killed inflation, and a recession goes deep, the Fed always reverses course and they drop rates to stimulate the economy. Because demographics do not give us what we need to stimulate the economy, the Fed has stimulated the economy for the last 40 years with low rates,
Mm-hmm.
right? Cheaper debt to try to get you to invest, try to get companies to invest in jobs, invest in future, invest in technology. They'll only do that if they're incentivized by low rates. And so the Fed always reverses course. The challenge here is that we have inflation higher than what we have in 40 years, but we have inflation that's not easy to kill. There's a
Yeah.
lot of different reasons that we have inflation, and supply side things that are not easy for the Fed to do anything about. So you take, for example, the price of wheat exports from Ukraine. You take, for example, the global price of gas and oil. So Russia just cut off a supply chain to Europe for gas. Well, it's not just going to hurt Europe, it's gonna hurt all of us, right? With higher gas prices. So one of the things that I look at when I look at are we heading into more inflation or a deeper recession, is that certain sectors like energy and food, and in some situations housing, the three main things that people need to survive, we're going to have a supply chain issue for quite some time, which is going to keep those key three primary things, the prices elevated, right? So at the same time that those prices are elevated, because the Fed can't kill supply in all of it, right? They or much of it. They're going to try to kill the demand for housing to bring it down, but they're not going to really be able to bring down food and energy anytime soon because of a lack of investment in food and energy over the last several of decades. So what I think that that does is it changes the dynamic of the history that says, oh, we're going to easily go into recession. The Fed will, they'll basically pull out and they'll lower rates and we'll go right back on track and we'll have a roaring economy. I think that the global and geopolitical things that are happening and what's happening with prices in those key asset areas is going to keep us where inflation is a higher risk than recession is, right? And so the Fed essentially has to try to kill two opposing challenges with the same tools. And I
Mm-hmm.
think what that means is they navigate to the middle for a while. I think we're
Mm-hmm.
going to have not mass inflation or recession, but stagflation, which
Oh,
is really
yeah.
a little bit of both, right? So elevated prices at the same time as decreased growth essentially means we're going to have some inflation that's sticky, that's here to stay for a while. And we're going to have a deceleration or a reduction in growth, a traditional recession at the same time. And
Mm.
if the Fed cannot kill both, I don't think that they're going to quickly reverse course and lower rates, because what it'll do is it will stoke inflation again right after they've tried to stabilize it. We'll be excited. We'll have free money again. And guess what? Everybody across, the country, across the globe will continue to spend on that cheap debt. and it'll drive up inflation to where it may take years and years and years to kill, which is kind of the mistake that they made in the 70s before Paul Volcker came in and really killed it. So the Fed is very aware that if they reverse course too quickly, it could get out of hand. It's already out of hand. So my bet is that they go after inflation. They continue to raise rates. They get us in a recession, but they don't call it a recession, right? Did you see the press release on Monday? The White House is saying, well, recession isn't technically just two quarters of negative GDP. It's much more complex, and we're not in a recession. They're going to try to say we're not so that they can keep raising rates, so that they can try to kill inflation. But I think we're definitely heading into a recession, more stagflation, and it's going to take some time before the Fed can safely try to reverse course. And all bets are off if things change and get worse geopolitically.
Oh, yeah. It's funny. I did a whiteboard discussion on what I call the most important economic decision or economic question. And I'm going to give it to you here. And I didn't have an answer. I don't know where I sit on this. So it'd be interesting where you are. So I basically drew a bar chart and put 9.1 on top of it, which is, of course, is the CPI number. And then I put at the
manipulated CPI.
Yeah, it is what it is, right? It's the number we have. And then at the bottom of it, I said 2%, right? Which is acceptable inflation. I said, okay, now we have a question. There's 7.1% of this is difference. We have one side of the camp, and I'll just say Cathie Wood, talking about deflation, bullwhip effect, all of that stuff. Basically, what Cathie Wood and anybody on that side is saying is 4 or 5% of the 9.1 is truly transitory. It's just longer than people thought. Right. So again, let's just say 5%. So you take 5% off 9.1, you're now at 4.1. That's a lot closer to 2. So the Fed doesn't have to go as high, right? Because again, they got to get back to even. They got to get constrictive. They could be there at 3.5, 3.25, or 3.75. They could, if Cathie Wood is right. Then you have Michael Burry and all these other people saying, yeah, we got some transitory, but it's not 5% like Cathie Wood thinks it is. It's more like 2%. So that brings it from 9.1 to 7.1. That's a big gap between 2%. And if that's right, the Fed's going higher and higher and higher and higher. So I don't know which one we're on, but that's a vastly different decision. What do you think?
Yeah, I do. And what I look at, we've had economists that have kind of different schools of thought as to monetary policy and what rates, do and do not contribute to. And really their mandate and what they try to do has changed over time. But in the recent last couple of decades, essentially what the Fed has done is they've said, we want a multiple mandate, right? We want employment at a certain level. We want inflation at 2%, and the Fed funds rate, the neutral is 3.5 to 4. And so that's what they're calling neutral. So ideally, many would have liked to keep the Fed funds rate always at 3.5 to 4%, so that if you hit a deep recession, you can lower the rates to stimulate the economy and bring us back out. But the global economy is actually so slow without the cheap debt over the last decade that global central banks have kept the rates well below neutral in this territory that's made our interest rates really, really low. And that has created inflation globally, but it's also created slowing lower and lower growth per year, even with low rates, because there's kind of this law of diminishing returns, where the more debt you put in to stimulate the economy, the less growth you actually get out of it. So knowing that the Fed is really targeting 2% inflation and a 3.5 to 4% neutral rate, I think they aggressively get us to 3.5 Fed rate and see what happens with inflation, see if it comes down closer to that 2. And then they move to 4 if inflation stays really sticky. But I think that they're going to change their mandate from 2% being kind of the norm of inflation. If food and energy prices stay significantly higher than what they want, they'll say, you know what? We need to get used to a new era, kind of this great reset. All of what the central banks are trying to do is get us into a new era and a different type of monetary system. I think they try to get the American people to buy a new inflation rate of 3 or 4% as the norm and as good as it's going to get, which is kind of that stagflationary thing we're talking about. So I tend to think that that higher inflation is probably here to stay for decades on end. I don't
Ooh,
think they're going to get it back to 2%. That's
yeah.
just my personal, thinking and everything that I'm watching. And that's assuming they don't reset the whole system, which
Yeah.
they're all talking about. So, topics for another time into the details of that. But the global central banks are saying, we've made a mistake. They were all modern monetary theorists that thought we can just keep printing money, keep rates low, and we'll never have inflation. That theory is kind of being challenged right now and
You think?
proven not to work, right?
Yeah.
So the old days of we need to balance budgets, we need to keep rates, high, they kind of threw that out the window, and they're seeing this doesn't work. We're going to have to change things. So I think we really are going to see kind of a new normal. And I'm not on that camp that just thinks that everything's going to bounce right back in a year and a half. They're going to cut rates. Everything's going to be just as it was, and everything's going to be back on track, a super strong economy. I'm a little more bearish than that. I think it's
Yeah.
going to take several years for us to get out of this. But guess what? I'm still excited to be a real estate investor, right?
Mhm.
Because people need food, energy, and housing. And if I
Agreed.
can't provide food and I can't provide energy, I'm providing housing. And the
Mhm.
prices will kind of work themselves out, right?
Mhm.
Wherever the new normal is for interest rates, that will impact the new normal for values. And then I'm really going to focus on that rental income that I can generate from those properties. So I
Yeah.
don't have to have it all figured out. We do need to think very intelligently about macroeconomics and micro and how it could impact us and the types of debt that we take on because of the uncertainty in where interest rates may go. But I'm excited to continue to provide housing, do really good deals that make sense for today, lock in as low interest rates as you possibly can for the longest period of time that you can. And the values and the returns and the cash flow and those things will kind of work themselves out over time. But I'm bracing myself for a few years of pain, and doing deals that are going to preserve wealth, have a little more cash flow focus than upside focus because we don't know what's going to happen to values
Mhm.
depending on what happens to those rates, and to just keep doing really good deals for today and watching what happens so that we can pivot if and when we need to.
I love all of that. And again, I don't have the answer to this. It's the most important economic question. How much of the 9-1 number is sticky versus not? Because it really changes the outcome.
It
I
really
le-
does.
I lean towards a lot more sticky housing, food, gas, all of that we've talked about. And why is that important? Because if that's where you are, and I think both of you and I would agree, we don't want any interest rate risk the next 3 years. Anything we do now is going to have debt that resets or comes up for an adjustment, certainly more than 3 years, if not 5 years. I want none of that stuff in the next 3 years. What do you think of that?
Yeah, absolutely. This is the time when we're starting at a bottom and we have uncertainty for you to basically de-risk your portfolio, right? Anything that you buy, you need to be thinking about the risk more so than actually the return, right? You want good, you want both, but you want to make sure you're de-risking everything that you do have control of because there's so many things that we don't, right?
Mm-hmm.
Even as a portfolio owner, if inflation keeps going up and taxes go up and insurance goes up and my utilities go up, my returns start to get really squeezed. So I
Mm-hmm.
want to be able to set something that I know, like, no matter what happens, this rate is set and this is what my debt service is going to look like. And that's either through fixed rate debt. It's maybe extending some of your fixed rate periods on commercial loans. So I play in the commercial loan space a lot. I really can't get that 30-year fixed on large properties, but I can get a 30-year AM. I can get 7 or 10 years fixed. I might now pay a quarter of a point higher to get a 7-year instead of a 5-year, or to get a 10-year instead of a 7-year.
Yeah.
And just go ahead and take the hit now to lock in that margin of safety. Or if you're doing large commercial deals, getting interest rate caps, they're expensive right now. They're extremely expensive right now, but you got to get the deal at a price point where you can get a price point that allows you rates to go up, cap at a certain amount, and assume that it's going to stay that way with some of your expenses going up a little bit over time. And if the deal still makes sense, you do the deal. But your debt is one of the most important things that you can consider and structure at this time to de-risk your portfolio.
I love that. Anna, where can people find you?
Great. You can find me here every week. You can find me on social media at Anna Kelly REI Mom and my website at reimom.com.
Thank you so much.